Hello, everybody, and welcome to VRIC Media, your most trusted voice in metals and mining. My name is Jesse Day. Each and every week, we are bringing the VRIC to you with our series of expert online panels. We have a wonderful one lined up for you today. We've got Patrick Karim and Kevin Wadsworth from North Star Bad Charts. We're going to be diving into some technical analysis of a variety of commodities: gold, silver, uranium, and more. Gentlemen, it is great to have you back on the program.
It's great to be here, Jesse. Very, very happy. Hopefully, we get to showcase some valuable charts there for your audience.
Yep, great to be here, Jesse. Thanks. Thank you very much.
Of course. Let's start with gold because this is probably the commodity that is the most popular at the moment amongst our viewers. I've definitely noticed that. Some might not even call it a commodity. They would call it money if you're a hardcore sound money advocate. Let's take a look at the technicals when it comes to gold from the perspective that you guys are seeing it, because obviously we hear a lot about the fundamentals of gold day in and day out. If you're involved in this space at all, if you pay attention to this space, that's generally the focus: the massive debt and deficits, the safe haven aspect, just removing your wealth from counterparty risk outside of the traditional financial system, how that can be, it can be a very useful tool in that respect. So why don't we break out the charts and have you guys tell us, firstly, walk us through gold's rise to where we are today, which is we're knocking on the door of $3,000. And secondly, where you see it headed moving forward. Do you think we're going to surpass that $3,000 mark and beyond? What are the charts telling you? Patrick, I'll start with you.
Yeah, look, it's not gold's look, you can make it very simple there. Gold is above an inclining 12-month moving average. It's above an inclining 3-year moving average. It's above a whole bunch of longer term moving averages. So it's in a bull market. It's going up. There's no reason to start looking at bear markets yet. Now, what do people want to know is like your audience has to decide. Are they traders? Are they position traders? Are they stackers, right? Stackers, you talk to a stacker price, he doesn't care, right? He just says, come on, every week he's going to buy, he sees like ounces in his head, right? And there's charts, to substantiate that like an ounce of gold, is going to be able to purchase you the same thing over very long periods of time, practically the same thing, right? You go back decades and decades and centuries, and that ounce of gold has preserved its purchasing power. So it goes back to your point there to touch on the fundamentals. Gold is money, and money tracks purchasing power changes in the fiat. So let's say you have your US dollar loses purchasing power. So the US dollar adjusted for inflation, then gold inversely tracks that. So the more your US dollar loses purchasing power, the more gold tracks that pretty much inversely. But yeah, I'll show you some charts, guys, because people say, Patrick, stop talking. Just show me the charts. If you want to see like from a fundamentals, I don't mind talking about fundamentals, but I need to be able to have a chart of that fundamental metric, right? Here I have the gross federal debt since 1939. So this essentially is the gross federal debt, guys. Here I outlined it. It's all the debt held by the government to finance whatever programs it has, the money it owes, Social Security, Medicare, all that type of stuff there. That debt, right? Not money supply. Money supply is, yes, I know money supply is, it could be borrowed into existence. Not that, not the currency in circulation. The debt, the federal debt is right here. So it used to be 48 billion, now 33 trillion. A lot of people say, well, it's the debt, right? And the more there's debt, you lose confidence in the government, etc. But if it really be that, gold would never have any bear markets because that thing's just going up and up and up and up, right? It's like by that standard, people say, well, how come gold's not higher, right? It's not doing its job. Well, if you look, it's always about momentum. It's about rates of change. And you see here, look back I know gold was pegged back then, but even the debt here, look at the rate of change of that 3-year moving average, not the rate of change, the distance from the moving average of that debt on a 3-year away from its 3-year moving average, kind of flat, right? And look at gold. Even if gold was pegged, I know they repegged it somewhere here. It was still fairly like nothing was forcing the markets to unpeg gold for because the debt was not exploding. But look what happened in 1969. Look at the debt here, jolt, the explosion in momentum and debt. Look at that, higher lows, higher highs, and guess what? Gold they were probably like, you could fit a narrative, but they were probably forced by the nature of because they wanted to take all that debt, the government, they had to unpeg it, right? Something was about to break. So here you have a bull run as the debt is exploding upwards. You have a crazy bull run for gold, right? And as soon as that rising trend line fails, look at that gold. That was its echo bubble. Even in 87 there, it tried to go back up. On a yearly close basis, it was almost as high as its 1980, right? Everybody sees the 1980 peak for gold. Yes, technically on its chart, if you look on the monthly chart, daily chart, you'll see there's a big spike. But it still tried here. But after that, once the momentum was lost for that debt creation, the federal public debt, then that was it, bear market. And look at that huge unwind and debt. The debt still goes up, but it's not going up as fast. And gold says, well, there's not as much destruction of purchasing power, and it just goes in a bear market. U.S. equities, they love this. U.S. equities, they love when the debt there's not the debt acceleration. And look at here at the bottom of the 2000. Look at that debt acceleration. Guess what happens to gold? Explodes. Higher lows, higher highs, and as soon as we lost that rising momentum, guess what? That was the top for gold. And look at the bottom here, 2015, Jesse. The bottom in debt creation momentum, and look at that gold since 2015 on a yearly close basis. I know like technically we had breakouts at higher levels, but it's been trending alongside it, right? And that's where we are today. This is a yearly close basis chart. We'll only know this gross federal debt at the end of the year. It'll be updated. You could maybe look at just at the total public debt. It's updated quarterly. But look at that. We're on that line once again. It's tricky, right? Because the bulls will want the debt to explode. So now, I don't know, you could fit a narrative. Let's say Elon is doing the Dodge thing, reducing government debt, doing a whole bunch of stuff. That's not bullish gold. If his mission succeeds in reducing the government size and the debt of the government and decelerating debt creation, that is not good for gold. It's not a bullish narrative for gold as backed up by the charts. But if it does explode upwards, let's say whatever Dodge does, it's not enough. And then we get a recession in 2025, which we could maybe talk about, but there's good chances. And they have to start doing bailouts. They have to start doing stimulus, to save the economy like any politician usually does. Then this would be the narrative for the bounce. We don't break this line and that goes up and then gold price rocket upwards. So that's my take on gold. I don't know if I know maybe it's not the pinpoint technicals. Gold is stretched on price chart, right? So it's very vulnerable for correction when profit taking zone, right? It's high above its moving average. Of course, it could go higher, but if you're on the sidelines, you see that it's probably not the optimal time to jump into gold. Even if it does, let's say, flare up to 3,300, it's the best time to get in was at 1,350 back in June of 2019 and around 2,100, 2,000 there just before this last run. Kevin, stop me. I'm ranting. I'm taking up all the time. You have to stop me.
I'm enjoying listening.
Any thoughts on gold that you'd like to share as well?
Yeah, just to add a little bit of color to what Pat was saying, I'll share my screen and show you a chart as well. What I wanted to sort of talk about is something called capital rotation. So you should be seeing the gold chart, and
Yep.
back in 2019, Pat said there was a low risk entry point there, and this is when we put out a chart suggesting that the price of gold was going to go to 2,000, consolidate for 2 or 3 years, and then break out. And of course, we now know that that's exactly what happened. That's the chart as it looks now. We got that 3-year consolidation and the breakout. But what's going on as we're breaking out through these very important resistance levels? What is the process that is taking place? And it's something called capital rotation. I'll just show you this little presentation here. Just note that priced in gold, all of these are in a bear market. So US money supply, the US dollar index, consumer prices, producer prices, currency in circulation, the equal weighted S&P, the New York Composite, the Dow Jones, the Wilshire 5000 and the Russell, they are all in bear markets priced in gold or versus gold. And that's illustrated here with this little table here that you can see. I'll just expand it a little bit. So all of these coloured in red are in bear markets priced in gold. The S&P and the Nasdaq are just teetering on the edge of breaking down into bear markets priced in gold. Gold is breaking out versus the S&P as we speak, and gold is breaking out versus Nasdaq as we speak. And when that process takes place, the S&P is expected to break down versus money supply, the US dollar index, CPI, and currency in circulation. It's all part of a process that only happens, as you can see in the text underneath, only happens during a capital rotation event. And a capital rotation event, a CRE event, is what is the terminology that we use to describe that thing that happens once every sort of 20 years or so when gold either breaks out or breaks down versus the stock markets. If we look in detail at the S&P, these are the 11 S&P sectors. There's 12 boxes here. The bottom right-hand one is the S&P itself. But we've got 11 sectors here, and all of these 11 sectors within the S&P are in a bear market now versus gold, just waiting for monthly confirmation on a couple of them, which have just broken down versus gold. But the evidence is now strong that gold is breaking out versus all of these things. And just to sort of add a bit more detail on that, just stop sharing my screen for a moment. Just to add a little bit more detail on that, we have the gold to S&P ratio, and I'll just get that on the screen for you as well, if I can reshare the screen. So the gold S&P ratio is this chart here. And what it illustrates quite clearly, I think, is that these rotation processes, as I say, they take place every sort of 20 years or so. And you get the rotation on this ratio chart, this gold to S&P ratio chart, in both directions. So it rotates upwards and breaks out, and that is gold outperforming the stock market, and that puts gold into a bull era. And then you get the rotation in the opposite direction where the chart breaks down, and that's telling you that the S&P is outperforming gold, and that's what leads into a gold bear market and an S&P or stocks bull market. So you can see very clearly that for several years now, in fact, probably about 7 years, maybe more, gold has performed equally to the S&P. This ratio has just gone sideways, trending towards a breakout. And if we zoom in, you can see very, very clear and decisive breakout is taking place this month. Now we're only halfway through the month as we're recording this. We've got another couple of weeks to go, so we've got to wait for the monthly confirmation. But if we close anywhere near these levels of gold versus the S&P, we've got a breakout, a fairly clear breakout of gold versus the S&P. So, in addition to what Pat was saying there about debt and how that plays into the gold narrative, you have a very, very clear process, well-defined process of what happens when gold enters a bull era. It happened in the 1930s, Jesse. It happened in the 1970s. It happened in the early 2000s. And all you have to do is examine what the charts were doing in those three previous examples and compare them to what they're doing now. And you'll realize that these things that I just showed you, they only happen all together at certain periods in history. The 1972, 2002, and now. And that's a capital rotation event. Capital, so how can I put it? The best way of trying to describe this, there's a relative capital flow change between the stock markets and not just gold, but commodities in general. Gold is kind of the anchor, and you follow that leader, and then sort of attached to gold, you have all these subsidiaries: silver, platinum, palladium, all the base metals, energy, oil, all the commodities, wheat and cotton and all these things. And they, at various stages in a precious metals bull era, at various stages, they will have their time to shine. They will have relatively brief periods where they outperform gold. So all you have to do is check their ratio charts versus gold. And if you're going to enter platinum, do it when platinum breaks out versus gold. If you're going to enter silver, do it when the gold-silver ratio breaks down and silver starts to outperform gold. So the way I would encourage people to think of it, gold is your main anchor point, and then all of the commodities complex and metals complexes hang off that, and they will pop like popcorn in a pan at various points. And they tend to have brief but very glorious bull market moves, and you can take massive advantage of that if you're able to analyze the ratio charts.
Well, you mentioned silver there. I'd love to get your take on that commodity because Once again, this is something that when it comes to a fundamental perspective, we have very low levels on the LBMA right now. If you talk to people like Ed Steer, David Morgan, Peter Kraut, these people who specialize in the fundamentals of the silver market, they're saying that we're in deficit. I was talking to Ed Steer the other day. He said we've been in deficit for 5 years now when it comes to above ground silver supplies. You hear all sorts of ratios. Obviously, the gold silver ratio is one of them that gets brought up a lot, how historically it's stretched at the moment. So this is why I love talking to you guys, because you kind of separate the signal from the noise and bring the technicals into it to kind of walk us through it. So could you go ahead and do that for silver? Let us know where we're at the moment, Patrick.
There's a big clue out there that people aren't looking at, and they're always expecting silver to blow up, right? When is silver going to do a melt up move, right? When has silver historically done melt up moves? And the gold silver ratio is yes, that chart. I want to talk about that one. You want to let that? I'll talk about that one. Then Kevin, just do the I'll just do the then you could do the price. Look at that historically. And Kevin, I had a version of this chart that goes back all the way to the late 1800s, late 1800s, Jesse. That's on the top one. It's silver priced in gold. So if that chart's going bottom to up, so that's where you want to be in silver, right? That's when silver has one of its runs. That's when silver is outperforming gold. And silver, the only times that it does these crazy moves that everybody wants, right? The Ed Steer moves, the Peter Croft moves, the clickbait, sell whatever you want to sell, move for silver. They happen only when silver outperforms gold. Because if silver's outperforming gold, like Kevin said before, you shouldn't even touch silver. It might go up nominally, but why own it? Gold's doing the job. But look at this. Look at the bottom pane. Silver is a recovery metal. Kevin and I have been repeating this. The bottom pane is SPX. And look at these bear markets in SPX. You see, went down 52%. Look where the gold to silver ratio really started rocketing in the 1975s at the bottom. The US equities have to bottom and start moving up. And silver, what it does, it prices in the debt creation. Like go back to my first chart of the federal debt, the stimulus, all that bailout, the government, all the borrowing they have to do, the destruction of purchasing power that will create. That's what silver prices in after the bottom is there. It recovers, it outperforms gold, outperforms SPX, outperforms practically everything. Happened in 1980, a little bit there, that run. Then look at the 2000.com bubble. If you front run that and you say, I'm going to buy silver, the markets are going down, there's a recession. No, big mistake. You have to wait for the complete unwind of the stock market at that 2002 bottom, then silver rockets, bam. So even if silver went up nominally, let's say it was at 15 and it's up at 20, 25 by the time the market's bottom, it doesn't matter, guys. Don't front. Who cares about that $5 move? Because you're going to be playing that $25 to $50 move, right? You have to think the greatest amount of gains in the shortest amount of times. That's the dream, right? And look, 2009, look at the bottom. Exactly. Why would you front run that? If you think US equities are better US equities and your speech is, US equities, bear market, blah, blah, blah. Okay, fine. Let's say they start rolling over. Oh, goodness, the cat. Let's say they do start rolling over. Then let that play out because you will be at you'll be at danger of silver not performing gold. So even if now silver, Kevin's going to show you it's starting to look up, moving up silver. But if there's a CRE, if there's a recession, and every time there's a recession, markets take a drop, and by the size of this one, it could be even a bigger drop. There's not from the fundamental macro, there's not much reason to be in silver right now. Even if it does go up, I'm not saying it can't go up. It's above moving averages. That's fine. But the true clickbait and moves, they're not here yet, guys. We're still ahead. We're still ahead of the curve. Silver could go to 35, and then after that, let's say the stock market's correct, goes back down to 30, or it goes to 40, then corrects to 35. I'm gonna play that $35 to $70 move. That's the move I want to play in less than 6 months. I want to play that move. I don't want to, take my chances and go in now, and then it goes up to 40, and then back to 35. And I waste a whole bunch of time.
And look at what happens with the gold silver ratio when we get recessions. There's a pretty good chance that the gold silver ratio spikes upwards. Now I know that recessions are backfilled often many months later, often even more than a year later. You find out that you were in a recession. You tend not to find out from official data in real time. But if you're thinking that recession is around the corner, then it's very likely that the GSR can do some sort of crazy spike upwards. We're in a rising wedge pattern, which is interesting from a technical point of view, because rising wedges, if and when they break down decisively, they they tend to be very bearish. We had a false breakdown here back in 2011, but the general chart pattern is a rising wedge pattern, which I do find interesting. But the overall point of this chart is to help you decide, should I be in gold or silver? Well, the answer is, if we start spiking up through the orange zone and towards the red zone, then that just reaffirms the fact that you should be positioned in gold. As things stand at the moment, we should have been positioned in gold for quite a considerable period of time, really, unless you're brilliant at timing these very short-lived spikes up and down. Then, if you're just holding holding metals over a long period of time, then the gold silver ratio has done nothing except go up over the decades. So gold is a long-term winner, with occasional very glorious periods where silver massively outperforms gold. Now, when we enter the green zone here, that is a time when you definitely do want to be making sure that you're positioned, at least to some extent, in silver, because that would be a major breakdown and likely to lead to a spike to the downside. How long that spike lasts and how far it goes, we don't know. But if you look at the silver chart itself, and that was the one I had on the screen a moment ago, I'll just get rid of the US recessions for a moment. They get in the way. We are effectively in a cup and handle pattern that goes all the way back to 1979 when we entered the cup. And this cup played out. Of course, during the 1970s, we had all of that going on, the gold coming off the gold standard. So all sorts of stuff going on, the Hunt brothers in the 70s as well, and all that kind of stuff. But since 1979, we've built out a very nice cup and handle pattern. And this, what looks like a cup that we're in at the moment, is actually just the handle on a much bigger chart. But the main point here is that we put this chart out around about 5 years ago now, and it's not really needed any change. So, as much as people get very excited during silver squeeze and very frustrated when that ends and the price of silver goes down by 50% and then sideways, all of that kind of noise is going on. But really, all it's doing is just, the chart is just playing out. The chart has never expected silver to reach the $50 area until we get here. And you can see the time on the bottom of the chart. You can see the date moving. We're into late 2025 there, even early 2026. So this is the time zone up here, really any time from now through to next year at some point, where silver has the ability to spike up towards this arc target, and that would be the forecast complete. That would be this particular forecast completed. But when you step back and you just look at what that would mean, and bear in mind what gold has just done, gold has just built out a pattern like this and broken out of it, then this is silver doing the same thing. So this is just one big preparation for what comes next. It's a cup and handle pattern, and if and when it breaks out, then just like gold, when it broke out of this cup and handle pattern, you can expect the price to accelerate away upwards. Of course, gold now, just briefly going back to gold, we didn't mention this, but very, very important point is that gold has also broken out from a 45-year pattern through critical resistance. So a rising wedge pattern with an upside breakout, which is always likely to be the outcome because gold tracks loss of purchasing power. Silver is doing much the same thing. So I suppose to summarize, the technical chart structures for both gold and silver are long-term bullish. The capital rotation evidence is very supportive of gold and silver going much, much higher over the next 10 years or so, in fact. From all of the technical sort of points of view, regardless of short-term corrections and pullbacks, which always do happen, of course, we are staring down the barrel of a long-term precious metals bull market at the moment.
Great summary. And I just want to clarify for those people watching who are maybe newer and have started stacking gold and silver, you don't need to worry about your entry points, as Patrick was mentioning earlier. You don't need to sell your silver and buy it back when it gets to these indicators that they've been talking about. This is more, you guys are more focused on shorter term trading. Is that correct?
Shorter term
Well,
trading within the longer term trend. So
Right.
identifying
yes.
those points in time when gold and silver are not stretched from their moving averages. Pat touched on this earlier on. If you're a trader, gold is currently stretched from its moving average. That is not the condition you want for a low risk entry. Okay, so
I'll share.
Patrick will probably talk about this a bit more, but you do have to identify in your own mind, am I wanting to trade this next move up when it comes, or am I wanting to position and benefit from the run that gold is making from $2,000 to $10,000? That's an approximate reasonable target. So if you're happy to just stack and use the long-term evidence, then you don't need to time it. Trading is very different. Pat's going to explain this. Distance from
Well,
moving average is really important, guys, by the way. If you're scrabbling around with technical indicators, trying to figure out how to use them, there's so much we could cover here. I mean, things like the stock RSI and all these oscillating indicators, people talk about them being overbought. When you're in a bull market, they have to be overbought for long periods of time. That's what a bull market is. When you're in a bear market, they stay oversold for long periods of time. Also, when you're in a bear market, an indicator going high and reaching its oversold zone doesn't have that much of an effect on the price. The price doesn't go up very much. But when you're in a bull market, as soon as the indicator turns up, the price rockets up with it and goes up a long way. That's the different dynamics of bull and bear markets. So those indicators can be a little bit tricky to use, but this distance from moving average indicator is universal in bull and bear markets, and they're identifying their breakouts as Pat's doing now, and identifying when they're low, when the distance from moving average is low and it's coiled and it's ready to explode. That and in conjunction with the price chart itself breaking out, those are your low risk entries.
yes. You see, this is objective. It's not trying to fear people into going into the gold, the LBMA, the rupture. That's, guys, it's noise, because often you'll always hear these most bullish narratives at the end of a run. It's the nature of the beast, Jesse, because when the price of gold was down here, look at all your videos, people were down, the narratives kind of aren't but here the price is stretched. The most bullish narratives, you find them when mathematically the price is so stretched away from its mean. Here, the most bullish narratives. Remember silver squeeze? Oh man! So it was this. Here the Greek banks, whatever was failing in 2011. So these bullish narratives, they always happen to be exposed because people have had gains and they feel confident in their narrative because they look at the past in the rearview mirror and they say, "Oh look, it went up the price. My narrative was right." But people don't have confidence as much to say those narratives when the price is low, right? Because it's just human psychology. So here, look, the low risk entry was back here, May of 2019. The next one is down here. It's not about price, guys. Low risk entries. Got it. Well, Kevin and I, we don't care about the price. We care about the price, but it's where is that price happening? You see, here we have an equivalent, practically equivalent low risk entry. The pattern was a little bit shorter here than this one, but because the entry point was coiled and tight, gold was 3,300 here. Gold was 1,350 here. Gold was 1,950, 2,000 here. But from this analysis, even if the price is higher on all these points, it's practically, I don't want to say the same, but they're in the ballpark of same low risk entry. You see how that works? That's why I'm not scared. People say, "Oh, Patrick, you're gonna buy gold." Let's say I think gold. I could buy gold 4,000, and if I have this structure here, let's say gold goes up a little bit, but it lets the moving average catch up, right? So let's say the moving average, I'm letting the moving average catch up, and then whenever that pattern breaks out here, and I get in, even if gold's at 3,500, Jesse, I'm gonna be looking at 7,000. For me, that's a low risk entry. For me, that's a place where the chances of gold going lower than my entry point are diminished. And people, you gotta look at this, guys, objectively, right? Don't fall in for the FOMO. Right here, unfortunately, we're in profit taking zone, 100%. Even if gold goes up 29, 30, 3,100, it doesn't matter. You're in profit taking zone. There is zero entry points for anybody who's looking at the charts. There's zero entry points for gold on the monthly chart. even if on the shorter time frame, there's a consolidation here on the daily chart that's starting to break out there. Just gonna move here. So here there's a move up, but because that consolidation, that pull flag is happening with the moving average stretch on the hard time frames, you still have those overbearing headwinds of the longer term stretchiness that might stifle this bullish looking correction right on the shorter time frame. So it's multi time frame analysis. It's nuance. Yes, guys, stackers don't care about the price, so they don't even need to look at charts. They just buy to infinite. But for anybody who wants to try to time it, um, it's just not the optimal price, the optimal time to buy it. It's just not there. You missed it, and it could take. You have to let the chart reset a little bit, and then get the next low risk entry point.
Well, let's
But
talk
for
about
people
your, yeah, go ahead.
But for people that are in, you could still ride it. So if you don't want to take profits into strength, as long as you're above an inclining 12-month moving average, just ride it, guys. You're because you entered at the good time. You're not stressed. You could just keep riding it until you close below the 12-month moving average into a little bit of weakness. Then you could say, I'm going to step aside. But for somebody on the sideline, there's just no low risk entries right now.
Let's talk about uranium, and I want to start with how both of you track the uranium price, because obviously it's a very opaque market. The spot price is thinly traded. There's not very accurate price reporting data, even from the price reporters. The term market, bunch of NDAs attached to these long-term contracts. You can't really get an accurate take there. You're looking here at the Sprott Physical Uranium Trust. It doesn't go back super far though. So is this your preferred kind of metric for tracking the price of uranium right now?
Yeah, it's I had the spot price for Ure there that went back
Yeah.
all the way to the 60s, 70s. The Quandiel they pulled out that data series don't have anymore, but I used to overlay them. They're pretty close. So it's for me it's sufficient. Uranium price right now, it's until this line here, this declining line is breached at the very least. This thing's falling apart there. So there's like there's no look at the low risk entries, guys. You see, look at this black line here, low risk entry here, guys. I'm hopefully I know we see look at that low risk entry, low risk entry. At least it lets the moving average catch up a little bit here before exploding upwards. But look how stretched it was. I remember back this when it was that stretched, it was uranium to 300, uranium to 700, the fundamentals. Look, but it was stretched. So people that bought low decide to exit, and now the price is falling apart. But
Yeah.
I'm never going to try to catch that because you just don't know, right? How many, Kevin probably could show you that. How many people, oh, it's cheap here. Oh, it's cheap here. Oh, it went up. Oh, it's cheap. Like it's been cheap forever. And then you see gold outperforming uranium like a madman. And you say, man, all my capital is locked into uranium because I believe in the thesis. But there's this gold junkie there is just riding up an uptrend. Even silver is like doing way better than uranium. A whole bunch of stuff are doing better than uranium. So for me, uranium, as soon as it gets back above here, I'll be happy. I look often, even the URA, I could touch on it. The miners, even the miners are falling apart a little bit there, losing trend line. So the miners, until they're able to get back above 32, it's kind of a desolation. Cameco looks a little bit better. I love Cameco. It's often outperforming everything, but the momentum still dwindling, right? It's like there's who knows how long this correction is going to last, right? It's is that a bottom? Maybe, but until something happens here and it breaks out, right? Look at Cameco here. That was crazy. Look, beautiful consolidation. All this you avoid it, and you just buy the breakout here, down here. It's that easy, guys. It's that easy. I just want to say it's not all breakouts materialize and they work out. There's a lot of false breakouts, but at least give yourself a chance. At least wait for the breakout. And if that breakout fails, it failed. But if it doesn't fail, then you ride these crazy trends.
There's this metric as well. Now, Jesse, I just want anyone watching this to get this into their minds. We are in a gold bull market, transitioning to a gold bull era by the looks of it. It's going to last for many years. So that means gold is outperforming the dollar, right? So do not price things in the dollar, right? When the dollar's going down the toilet, gold is massively outperforming the dollar. So price stuff in gold because you can hold gold, you can own gold, you can profit from gold because it's outperforming the dollar. So in your mind, you have to think, right, well, if I'm going to invest in something, it's got to be outperforming gold. Because if it's not outperforming gold, what the hell am I doing? What is the point in holding anything that isn't outperforming gold? So all you have to do is pull up a ratio chart of stock X versus gold, stock Y versus gold. If you're going to get into palladium or platinum, do a platinum versus gold chart, and you'll very quickly see there's absolutely no point looking at platinum at the moment. And the same for uranium miners. We knew if our members are watching this, they'll know, you know, full well, because we talk about this every week in the Market Roundup podcast, that we have been telling them that the uranium miners are not at a low risk entry point. We exited with profit, so it must be over a year ago now, at least a year ago. And we've watched this correction play out over the months, and we haven't been tempted back into the market because there's been no breakout. We hit the resistance level of the uranium miners versus gold. This is URA versus gold. When it's going up, uranium miners are outperforming gold. Hit resistance, started to show weakness, get out of the market. We reached our profit limits on our trades, and those that hadn't reached their profit limits just exited anyway. And this thing has gone nowhere. And in fact, more worryingly, just in the last month, a massive breakdown here. And we're below the ratio is below the moving averages, below the Ichimoku cloud, below the support line. Guys, that is bear market territory. Okay. Whether it's a bear market, continues to be a bear market for uranium miners on their nominal price charts remains to be seen, but it's a bear market versus gold. So do not touch uranium of any sort when it's in a bear market versus gold. What do you do instead? You look at the gold miners, the silver miners, okay? Because you've got the tailwinds in that sector. Gold is doing great and the miners are breaking out. So your attention should have been on those for a while, and should not be on the uranium sector. You're going to hear all sorts of bullish stuff from all sorts of people about uranium, and you know, I'd be quite surprised if uranium doesn't come back and have a much more bullish spell during a gold bull era. I would be quite surprised if uranium doesn't. But at the end of the day, I don't ultimately care if it doesn't, because we're not invested in the uranium sector, and we're not invested in the uranium sector because uranium is not outperforming gold. You know, bet on the fastest horse in the race, not the one that has just, you know, fallen at the first fence. And I'm afraid at the moment that is what uranium miners have done.
Kevin, I just heard a whole bunch of hearts break there in the audience. The hearts, you
Yeah,
just broke some hearts. How dare you? How dare
including
you
my
say the truth?
own. Yeah, including my own. But longer term, though, when it comes to
Yes.
uranium space, and obviously you know that a lot of my portfolio is uranium. If I'm asking you this question, longer term, when it comes to the uranium mining space, what is your outlook?
Yes. I'll show you this. Look,
Let's say
because
five. Let's say over the next 5 years or whatever.
this is chemical priced in gold, because chemical it outperforms the URA practically, you know, most of the time. So, and we have more data. So in a bull era, so if gold, we have the CRE, the capital rotation event confirming gold breaks out versus stock markets, and stock markets enter a recession, uranium should do fine. After, like, you know, whatever, uranium should probably, here's chemical. See, it broke out, chemical broke out versus gold and had a great run all the way to GFC. So what could happen here, let's say we get the capital rotation event, then the flows, they go into, they leave the stock markets and all that. You could have some type of pattern here that morphs. And then after that, you get this that goes up. This is more likely in the coming years than this going down, if we think we're going to have you know, if we go in the precious metal bull era, right? Not just the bull market for gold, silver, and all that. They're outperforming U.S. stocks, then this should go up, because it looks, you know, it feels bad here, but it's still a higher low, right? So all we have to do now is carve in the next higher low, and then after that, as soon as you do, you break out of that wedge pattern, you're off to the races, right? But you don't buy here because you just don't know how long it's going to stretch, right? But the long-term roadmap, you know, it could 100%. This is more possible than this, 100%. this is way more possible for me that it resolves upwards. But while the pattern, you never front run a pattern that hasn't broken out yet, because you don't know that it's a bullish looking pattern, but it's only a bullish pattern once it confirms and breaks out. It's just so you just have to wait. Right now, uranium. What I love about uranium being in a correction is I'm watching the next low risk opportunity in front of my eyes. All I have to do is keep watching it, and after that, bam! As soon as it breaks out, you enter like a champion, and then you can have those laser eyes. What do uranium guys have in their eyes there?
I don't think that. I think they don't have
Radioactive
anything.
plutonium, Pat.
Yeah, they usually just put uranium in their Twitter handle. I'm telling you, these days, the guys that have uranium in their Twitter handle name are all throwing in the towel and saying the thesis is
Yeah.
dead. They're arguing with people who are being bullish, and it's like your name says uranium investor, and you're on here constantly talking about how bearish things are for
Well,
uranium. It's fascinating
that's a
from a
good sign,
psychological
actually, Jesse.
perspective.
It's
Yeah.
it's good that sentiment, but that sentiment could persist longer than you would expect. So
Yes.
you just have to wait. This is just a waiting game right now. But
Yeah.
for people on the sidelines, right?
Well, let's talk about oil. Let's finish things off with oil. How do you guys see the oil markets positioned? Once again, I'll bring up some of the fundamentals that everybody's talking about. On the bearish side, people are saying, well, renewable energy is going to be the next big thing. We're going to switch to EVs or hybrids. The demand for oil is going to drop off a cliff. Other people on the bullish side are saying, well, actually, production in the US is rolling over. Shale production is starting to roll over. All the big oil fields are no longer producing as they once would. And when an oil field rolls over, it doesn't do so slowly, it does so at a rapid pace. People pointing to the fact that OPEC has much less spare capacity than people are letting on. The emergence of the middle class in developing nations requiring more hydrocarbons, on and on. You guys have heard the stories. What do the charts tell us?
Well, this is a classic case of being able to cut through the noise with a technical chart. Probably some people looking at this, Jesse, will think that technical chart analysis is some kind of voodoo. It's some kind of, a lot of people think there's nothing in technical analysis. Stop for a moment and think about what technical analysis is. It's the views and opinions of the aggregate of market participants, and that includes market participants who have huge buying power, who probably know a lot more than you or I or anyone listening to this will ever know. So their views and opinions on the market are only reflected in one place, and that is the price chart. And second to that, what do you think is driving the price chart as well? It's the buying and the selling, the aggregate of the buying and selling, which is not just people like you and me, of course. As I say, it's those bigger entities. And when price crosses particular thresholds, not only human analysts recognize those thresholds, we have AI and algorithms that recognize these thresholds. So when I put a 3-year moving average on a chart, or the Ichimoku cloud, or volume resistance, or trend lines, they are all recognized by the algorithms, and that will trigger buying and it'll trigger selling. So there's a logical, very sensible reason why these seemingly random lines on the chart appear, and you can recognize them, and price reacts around them. Oil in particular is an interesting one because we had this enormous false breakdown back in 2020 during the COVID panic. Of course, oil was literally being given away, and it was, I think, on some indices, the price of oil went negative, didn't it? But when that happens, you usually get a very violent reaction in the opposite direction, and we were able to say that at the time, and we did that with bond yields as well when they broke down, and we got that violent upside reaction. What we have now is what is often called a bull flag building out on top of this former resistance line. So from a technical chart perspective, whether it's West Texas crude oil or whether it's the Brent crude or US oil, whichever chart you're looking at, this chart pattern shows up over and over again, a bull flag on top of the resistance line that we broke out of. So all we can say is we are now being compressed into a very tight trading range, and oil is going to make a decision one way or the other in the relatively near future by the looks of it. If it breaks out, and with Brent it's anywhere around about $75. I think with West Texas it was a little bit, maybe a little bit less than that, as it runs 72, 73. So roughly that $75 area, a breakout there would start to signal a likely upside resolution. And that likely upside resolution, from many points of view, actually, and many technical techniques, would put it north of $200 eventually. So that might sound like a lot, but when you consider how little the price of oil has moved over the last decade or more, that doesn't sound unreasonable at all.
You have,
Yeah,
I want to add something, Kevin,
yeah.
if I may. People got to remember, they look at the fundamentals of oil, but you got to also remember the macro destruction of purchasing power. What is oil denominated in on that chart? US dollar. If the purchasing power of the US dollar gets destroyed, let's say they have to print so much money, the debt, federal government debt goes through the roof. The chart has to account also for that, right? And oil, the oscillations in oil is the inflation rate, but it compounds also the destruction of the inflation rate applied to the US dollar. It compounds that. And every time, I don't know if Kevin could zoom out, but every time gold has had, it went up, then it plateaued, then went up. It was at the CRE events. Put a US oil, do you have US oil? Just type US oil. And so that's another big macro thing. Like right now, that like Kevin said, that pattern, it's very skittish. But if you zoom out, every time oil went from plateaus, like spiking up there, here's that 1971. It went crazy, right? That was at the first CRE where gold broke out versus SPX, and SPX went a bear market. Then and oil went sideways. Look at its other second leg up, that crazy leg up. That was at the CRE turn. And right now, if we think we have another CRE, another destruction of purchasing power, another bull era for precious metals, uranium, copper, and all that stuff, well, the bias is that oil should resolve upwards, right?
And just
But
look at the
you can't.
percentages there: 1,200%, 1,200%, 1,200%, and that just happens to fit with measured move. So that's around about $250. So you can use a number of different chart techniques to estimate bull market targets. But the idea of oil moving up 1,200%, to some people, what kind of world are we going to be living in? It's terrible disaster. People say the same when you talk about gold going to $10,000. That means it's going to go up 500%. What kind of world are we going to live in? Guys, it's happened before, not once, not twice, three times, over and over again. Commodities, oil, gold, silver, whatever, they have these bursts of moving up hundreds of percent. All they're doing is tracking loss of purchasing power, because general equities suck capital away from commodities for a period of time, and then it roars back with a vengeance, and it roars back with a vengeance to a point where it prices back in all of that loss of purchasing power. It's just the beach ball underwater reasserting itself on the surface of the water after being held under. So it's nothing. It's just physics and mathematics at work here. Nothing more complicated than that, really.
Yeah, and you do hear that a lot. If gold's at $10,000, you've got bigger problems to worry about than your stack of gold, because the world will be in chaos. $250 oil, well, same type of narrative. So that's very important that you pointed out those historic times when we have seen that type of incredible price performance to the upside. And we've ended on a good note, because my portfolio is very overweight uranium and it's very overweight oil equities. So now I'm feeling happy. But
Always a pleasure, Jesse.
let's talk about North Star bad charts. This is an incredible conversation, and you guys clearly have very great insights using your chart. So talk to us about your service at North Star Bad Charts, where people can find it.
Yeah, sure. NorthStarBadCharts.com. It's a technical charting service. We provide all of these charts across all the sectors: precious metals, uranium, oil, commodities, cryptocurrencies, stock markets, in the form of posts and podcasts and trades, of course, as well. So we've got some exciting trades to look forward to, hopefully, as well. So yeah, that's where you'll find us, and you'll find us both on Twitter as well.
Great. Well, I'll put a link in the description to the website for people who want to check out North Star Bad Charts, as well as to both of your Twitter profiles, because you do post frequently there. Some really interesting charts and information as well. Gentlemen, it's been a blast once again. I cannot wait until our next conversation.
Good
Thanks,
stuff,
Jesse.
Jesse. And yeah, spot the deliberate mistake there. I did call it Twitter instead of X. I'm still getting that into my head as well.
Same thing. All good.